Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Paul Robson, who is our European head of G10 FX strategy, and it has been quite a week in markets. On Wednesday, we had the announcement of US auto tariffs from the US. The tariffs were announced at 25% on both whole cars, but also auto parts to come into effect on April 2nd and also by the 3rd of May. However, the market reaction was pretty muted, didn't really seem to take markets, at least currency markets, by much surprise. But it does feel like the markets are really in wait-and-see mode ahead of the big event, which is on April 2nd next week, as we wait for the announcement of reciprocal tariffs. Paul, it seems like there's a lot of moving parts as we look ahead to next week. What are you really thinking about as we head into this big risk event?
Yeah, as you say, lots of moving parts, and I think that's why markets have not reacted too much to recent announcements. You quite rightly pointed out there, auto tariffs. I'm sure we're going to get more on sectorial tariffs, but as Donald Trump says, he thinks it's going to be Liberation Day for the US. So we think we're going to get something on reciprocal tariffs. We think we're going to get something on sectorial tariffs as well. There might be some other related reports on currency manipulators, for example. We don't think that will be a huge focus for markets. We're going to get, we think, a review of China's phase one trade deal, and we're also going to see the deadline for Canada and Mexico tariffs that were sort of delayed as well. So sort of putting all that into a big pot and see what we get out of it. I think at one level, it feels like we're being guided to one country, one number. So each country is going to get a specific level of tariffs. Maybe that will be based on reciprocal tariffs, but there's also things like non-tariff influences here, like intellectual property relations with the US, perhaps simply what the president or who he particularly likes over each different country as well. So it's very hard to have a framework for really understanding it. But he did mention when he was campaigning to become president for the second time, a sort of universal tariff of 10%. That's quite a lot different on a lot of economies if he just has reciprocal tariffs against the European Union. So there's quite a lot of wiggle room in there. In terms of sectorial tariffs, we've obviously had autos. That was the big one, but we might get them on, steel and aluminium, copper, and all kinds of other specific industries, pharmaceuticals, for example. So we'll be watching that particularly carefully. The other thing that I'll be looking for is the geographical breakdown of tariffs. So to what extent tariffs are actually imposed on sort of North America, sort of the old NAFTA economy, so Canada, Mexico, and the US, because they've got integrated supply chains. And one of the worries of financial markets appear to be the hit on growth of tariffs, because you start sort of putting on tariffs on goods that cross the border one, two, three times. So, and that's worried people. Growth expectations have come lower. Inflation expectations have risen. That horrible word of stagflation. But if he goes a little bit easier on that, maybe the dollar goes is supported a little bit. But I've got a feeling you're going to ask me about the currency in a minute anyway.
Well, on that note, Paul, what do you think this all means for the dollar? And of course, how it actually plays into the Fed's reaction function?
Yeah, I think for the dollar, like I said, it's about that geographical breakdown. So less on Mexico and Canada. I think that's a little bit more supportive of the dollar. But if it's less tariffs elsewhere, like on the European Union, on the UK, on Asia, then I think that's slightly negative for the dollar as well. But it's hard to have much confidence. For the Fed, which I think is important for the dollar in terms of rate expectations, I think there's two things we should be thinking about here. The first one is the relative pricing of recession risks. Is that correctly priced by markets? Growth going to be weaker, inflation higher? And the other key question, I think, for the Fed is their interpretation of how persistent any inflation might be from tariffs. And here is you're getting a difference of opinion on the FOMC. So Powell at the last press conference seemed to hint that any inflation would be temporary. But recent FOMC speakers this week have stressed that it's a little bit more persistent, and whether the Fed won't be able to cut rates by the sort of 2 or 3 times that markets currently have. The not cutting rates this year is a theme that sort of resonates a little bit more with our economics team. There is a risk that rates come lower in the US towards the end of the year, but the first half of the year or mid to middle of the year, the Fed won't have confidence, they'll be cautious, they'll keep rates on hold, and that might be a challenge for the market. So you've got these two factors. You've got the impact of weaker growth that sees maybe capital leave US asset markets, but then you've got the support of maybe higher for longer rates. So it feels like for now the dollar trades in a relatively tight range until we get more clarity on how that terrible word transitory inflation is and stagflation.
Absolutely. And I know, sometimes when we get those tariff announcements, it could be really telling actually how the currency trades in reaction to it. So, for example, we went short euro check off the back of those auto tariffs announcements on Wednesday because you really saw, very little consequential sell-off in the Czech corona, and it was really telling that the market was overly positioned. Our own analysis actually suggests that there's very little impact on the Czech economy from US auto tariffs because that theme of nearshoring has really been played out over years. So actually production has really all been localized to either the US or Mexico or Canada. So other kind of European economies are more insulated from these threats. But let's move on from tariffs. And obviously the big thing over in the UK was fiscal risk with the spring statement happening this week. Paul, what were your main takeaways? And I guess what did it mean for the currency?
Yeah, I think in the end there was actually few surprises from the spring statement. I think the general expectation in financial markets was the government would be keen to maintain or restore the level of fiscal headroom that had been eroded away by lower tax receipts and increased local authority spending. And they did exactly that. They did enough to restore that headroom relative to the fiscal rules that they had previously. In doing that, they had to rely, I thought, on a little bit of charity from the OBR by raising some of the growth forecasts, the estimates of future productivity because of planning reforms, which I don't think was particularly expected. The main bit on spending cuts was welfare reforms, and actually OBR took a less positive stance on that than the government and the Treasury were expecting. And it was only because of this slightly stronger growth and some cuts in spending right at the end of the sort of forecast period that allowed the government to meet its official rules. They do say, don't they, that the proof is in the pudding, and I think it will be over the next sort of 3 to 6 months whether those economic projections in terms of growth and inflation and productivity are actually achievable. And I think we have to remember that even before the ink was dry on the spring statement, the public finances were already shown to be deteriorating more quickly, so the forecasts were almost out of date. So when we get to next month's release of government borrowing numbers, there will be some adjustments into how the government plans to fund these spending from last year as well. And I think that might be a time when markets start to worry a little bit more about fiscal policy. We saw it under the Conservative government. We saw it in January. The sterling, the currency, is the release valve for such worries. And if people worry that gilt yields, long end interest rates, 10-year interest rates are rising more than they are in other major economies, then the risk premium might rise in the currency. And what I mean by that is that people might demand a lower price in terms of sterling to buy UK assets, which is they need to be compensated for some of the risk. So we're a little bit more cautious on the currency. People that know us here at NatWest, that we do tend to be a little bit more confident about the currency than maybe the average sort of the consensus. But here we're just a little bit more concerned, and we're definitely watching how the currency moves with interest rate expectations. So normally you find interest rate expectations higher, currency higher. But if what we find, if higher long-term interest rates starts to lead to weakening in the currency, that would be a sort of red flag that we would need to be watching more carefully.
I think you are the last sterling bull poll who's unfortunately losing their optimism. We did also have UK inflation this week. What did you make of that? And I guess how does it really feed into the Bank of England's decision?
Yeah, I don't think it changes the outlook for the Bank of England dramatically. We had the sort of the key headline numbers were a little bit softer, which was good news, but some of the detail was actually that inflation had become a little bit more persistent. Remember, we've talked a lot about service sector inflation. That's what we should be concentrating on. That actually, the annual rate of service sector inflation actually rose rather than falling, and I think that just shows that inflation is being a little bit more persistent than perhaps some of the more dovish members on the Monetary Policy Committee is expecting. But I think generally the MPC is guiding us to a sort of hawkish pivot in a little way. The sort of minutes of the last couple of meetings, some of the speakers, we're going to have this near-term rise in inflation, whether it's because of energy prices, national minimum wage, the impact of the last year's budget in terms of national insurance, and it's about that persistent. And I think that they're less confident that it's going to be as transitory as they previously expected. That again, that terrible word that we keep going back to. So our economists still feel that rates will come down, but they'll come down at a relatively measured pace, and they might reach the end point, the low point, terminal rate, landing zone, however you want to talk about it or describe it, maybe a little bit later. But at the moment, we're hoping for a quarter point cut in interest rates in May and August, but maybe that just comes a little bit later.
And Paul, how do US tariffs really impact sterling from here as well?
Yeah, I think this is where it might be a little bit more positive. Obviously, I've talked about some of the risks to the currency through fiscal policy. Some of the support for the currency through monetary policy, particularly, but we think that balance may be shifting. When it comes to tariffs, I think that on a relative basis, the UK might not see the most severe implementation of tariffs. We've spoken in the past about how the UK and the US has a broadly balanced trade position between each other in goods, and that seems to be the focus. Of course, there's things that the US might want to try and get a deal on. Maybe they don't like the idea of VAT on goods, and whether they see that as some kind of protectionism on tariffs. We obviously think it's not the case, but doesn't mean that other people have different views on that. Access to the NHS, access to food, pharmaceuticals as well. So, but I think relative to others that have larger manufacturing bases and larger surpluses in goods with the US, they might be impacted more by tariffs. So, I've said it lots of times over the last year, maybe the UK and sterling benefits from just being mostly harmless when it comes to trade. But with a lot of these things, it really depends on the president and his interpretation, and there's lots of grey areas within the tariff policy.
Mostly harmless is not a bad thing. And Paul, just wrapping all this up, what does it mean for your sterling outlook?
Yeah, I think actually I sort of covered a few of those, but just to be clear, we do think the balance has shifted from a sweet spot in fiscal policy, where we thought looser monetary policy, more borrowing, higher interest rates. We sort of talked about sterling being the carry king of 2025, and that's had us in good stead for the first couple of months of the year. But we think that that balance is shifting. Maybe we're in an inflection point. But the trouble with fiscal risks for sterling is people don't worry about them until they suddenly do. And trying to actually pick the level and the timing of that is quite difficult. So I think for us, we're just a little bit more neutral, a slightly negative view, I think. Maybe more against European currencies going forward. But as you sort of mentioned about the tariffs, there are lots of moving parts of this, and we've got a few positive drivers and negatives. But our number one focus, I think, for the next 6 months is going to be fiscal policy.
Okay, really interesting, Paul. Thank you so much for joining us this week. That's probably all we have time for this week's episode, but do remember to like and subscribe. Thanks for joining. Goodbye.